Kalispera. Kalos ήρθατε στο Snappi Hub. Welcome everyone, in English as well, because we have foreign guests, our distinguished Professor Altman, but also people watching us over YouTube Live. My name is Piret Reinson. I'm head of corporate communications at Snappi Bank and also curating the program at the Snappi Hub, which is the only physical touchpoint of the Snappi Bank, the first Greek fully digital bank. And I'm very, very happy, humbled. I feel like I'm very emotional right now, because I was very happy when Professor Altman, first of all, accepted our invitation. It was already, I think, 4 months ago, so I have been working with this concept quite some time, and now we are here, and I'm very, very happy to introduce Professor Edward Altman, and I hope you enjoy this discussion, and obviously we will have lots of discussions, more detailed, more personal after the official part. So I'm sorry, our live followers, that after the presentations we will stop the live session and we will take live discussions here between this audience. And very important for you, please join our Wi-Fi here. It's guest, Snappi guest. The password is, you can see on the signs as well, but it's your new bank. All the first letters are capital, but otherwise small ones, because you will be part of the history. Actually, we will co-create something together here. So be ready. I'm very excited, and I'm very excited and honored to welcome Mr. Professor Edward Altman.
Good evening, everyone. I hope you can understand my New York English, but if you can't, I know there are many people in the audience who can assist me. It's a great, great pleasure to be here today with you on behalf of Snappi Bank. Gabriele, who I know from some time in the past, was probably very instrumental in inviting me here today, so thank you so much, Gabriele. Thank you also the colleagues at Snappi Bank and the warm reception that we have received here in Athens. This is my 4th visit to Greece. The other 3 times we were mainly on a boat circling around your wonderful islands and visiting various cities and villages. My wife and I have already enjoyed so much. By the way, if you have time, I recommend strongly to see a wonderful exhibit of Maria Callas here at the museum within walking distance of this place. I have many things to discuss with you today, and hopefully you have interest in what's going on primarily in the United States, but also globally on several related subjects. I've been studying finance and credit now for, well, next year will be 60 years. So I always remember 60 years because it was 59 years ago that I built my first model for predicting bankruptcy of companies. Also, 59 years I've been working at New York University Stern School of Business. I haven't figured out yet how to get another job, so I'm still at NYU. And 59 years ago, I met and married my wife. So I always remember how many years I've been married, because I think when I built my first model, and then I can remember. On this trip, I have the pleasure of visiting first Italy, and in a small island that you may know called Sardinia. We had a fantastic conference on the ecosystem of small and medium-sized companies, which, of course, for Europe is the lifeblood of most of the countries. And I had the great pleasure of being a keynote speaker with one other gentleman. And, well, among other things, together, we have been on this planet 175 years. And 120 years of experience in credit markets. So one of the lessons that I hope that I can impart on you today is the importance of understanding history. Whatever subject you are studying, whether it's geopolitical issues or financial issues, economic issues, and the like. And I will try to explain why history is so important and what we can learn from history about what's happening in today's markets. The three subjects I will discuss with you are, first, what is concept of credit cycle. I'll come back to that. The second subject is leverage finance. And the third and related subject is the incredible rise and the main risk element today in the global credit market called private credit or private debt or non-bank lending. I've been studying this new phenomena for a few years now, and we've seen incredible growth, but now incredible frictions and discontinuities and problems. So we will discuss how significant they are, how contagious they are, and whether or not they are symptomatic of a bigger problem. And by the way, I have a long PowerPoint, which I'm sure Snappi Bank will make available to anyone who's still interested on the subject. But first I'd like to present a question for you to think about, and we will revisit it perhaps at the end, as well as discussing it as we go through. And I have a long presentation, so thank you, Snappi Bank. I understand everybody's okay to be here till midnight. So there's some snacks there, and we all can be together for a long time because we have lots of material to cover. But seriously, most of you are familiar with the concept of a business cycle. Growth of GDP, unemployment, inflation, trade deficits, tariffs, and macroeconomic subjects that most of you have studied in university or have actually worked on in an applied way. But how many of you have studied the credit cycle? And how do we define a credit cycle? And more importantly, and this is the question I'd like you to consider, and then we will revisit, do you think the business cycle leads or lags the credit cycle? Or does the credit cycle lead and give information about what is coming with respect to the business cycle? So that's the general question that I'd like to throw out to you to think about. But before you can even attempt to answer that question, we need to discuss how you define the credit cycle, because there's very little written in textbooks or journal articles about the credit cycle in terms of a common body of knowledge that everyone agrees upon. So I'd like to present my idea. It's a very simple one of how you define a credit cycle and refer to the current situation at the end as to where I think we are and may be going with respect to both the credit cycle and potentially the business cycle. So one way of thinking about credit is having a spectrum of 4 categories. Benign, that is a cycle when interest rates are generally quite low. Default rates among borrowers are also quite low. Non-performing loans, not very serious. If there are defaults, the recovery for investors, for lenders, is very high, so the loss rate is low. And generally, lots of liquidity. So it's easy to finance new investments, whether it be for firms, individuals, for financial institutions, and the like. So that's a benign cycle. And for the most part, since the great financial crisis of 08-09, at least in the United States, we have been in a benign cycle. Lots of liquidity coming not only from the US but globally, and relatively low financial problems in terms of defaults, recoveries, and liquidity. However, if things begin to unravel or get a little bit more risky, we have an average credit cycle. So, of course, when you talk about average, you need historic data. You need to be able to refer to, for example, the average default rate among companies, or bankruptcy rate, or non-performing loan rate over, if possible, 50, 60, 70 years. And how have these defaults been synchronized with respect to economic recessions? We are very fortunate in the United States. We've had many recessions. And as a result, we can study the relationship between the business cycle and the credit cycle. That's the average. So, for example, in case you're interested, we have a market you may have heard about it called high-yield junk bonds. These are bonds issued by non-investment grade companies, more risky companies, but generally reasonably large companies issuing bonds directly to the financial community. And that market, I was very fortunate to be the first academic to study this market back in 1981, when I was asked by Morgan Stanley, a big investment bank, to recommend to them whether they should get involved in this market called junk. You know, you have something called junk food, junk mail, junkyards, junkies. So it's not a very nice name, but in fact, it is a legitimate asset class in terms of a risk-return trade-off for investors who are willing to take more risk for the prospect of higher returns. And that is one of the 3 main categories of leverage finance. So, average. If things really become difficult, we have a stressed situation. Above average default rates, low average recoveries for lenders, a reduction, dramatic reduction in liquidity, and lots of financial problems, which are usually associated not only with firms, but with individuals and with sovereigns. And finally, we have a crisis. Well, you can say, how do you know what a crisis is? And most practitioners will say, oh, you know it when you're in it. And of course, the last one, you in Greece know very well, around 2011, 2012, the great financial crisis of 08, 09, which was mainly a real estate and financial institution crisis, the epicenter being in New York City. And in terms of a practical definition of a crisis, I like to, but it's very personal, I like to talk about when the default rate of a population, like small and medium-sized companies or large companies or individuals, is more than 10% for at least 2 years. It's ad hoc, but it's very difficult to define a crisis, but we know it when we're in it. And the question is, could you have predicted it? I must say that I wasn't the only one. There are some individuals, particularly who are in the real estate market, who predicted the 08, 09 crisis and made an incredible fortune by selling short real estate related assets before most people knew about it. And I was an advisor to a hedge fund called Paulson and Company, and there's a book out you can read about it called The Big Short. And it was the discussion of how you can short a market that you think will have financial problems. So that's the spectrum. Again, the question is, does the change in the credit cycle from one of these categories to another, perhaps getting worse, lead the change in the business cycle? So that's the question. We'll come back to that. Now, before we get into discussing my main passion has always been corporate distress, corporate bankruptcies and the like. I must tell you, and it may sound very sadistic, I love bankruptcies. I love defaults. Now, the reason is, as a scientist, you need data. You can't build models very easily unless you have data to test the models. And if you build a model, the caveat should be, I believe, it should be simple so that other people can replicate it and compare the new models with the old models. And I have another presentation that maybe you'll invite me back to talk about the evolution of credit risk models going back several hundred years on how credit scoring models have evolved to the current situation. And we all know now the big rage is artificial intelligence, machine learning, and other algorithms that make use of data much more efficiently than was possible when I built my first model, which was when I was a graduate student at UCLA in California. And at those days, imagine doing empirical research without computers, without databases. And so we had to, it was very primitive, but you really learn very well about the subject if you have to gather the data yourself rather than someone giving it to you. That's the subject of another discussion. So, but as background for our discussion on leveraged finance, let's talk about the global debt situation. And Greece, of course, knows very well these categories, but most central banks break down leverage into 4 categories. Non-financial corporate debt on the left-hand side, government debt, sovereign debt, financial sector debt, banks, insurance companies, brokerage firms, and household debt. These four categories are standard among central banks and macroeconomists to talk about the global ecosystem of leverage. And this chart shows you the trend in the growth of leverage in the financial community for these four categories. I'd like to concentrate today primarily on the first and the second category, non-financial corporate debt and government debt. Not that the financial sector is not important, and that was, of course, the main issue with respect to the great financial crisis, but because of bank regulation and the fact that banks now are considerably healthier for the most part, with far more equity and less leverage than they were 15 years ago, that's not as much of a central concern, in my opinion, about where we are today in the financial community. But of course, a bank like Snappi Bank is more interested in the last category, household debt or personal debt. And that's a subject I think we're going to hear a little later on about the work of Snappi Bank and also the importance of the private sector. But today, at least my part, will be discussing more the growth of, for example, non-financial corporates. So back in 1997, all the debt of companies was about 64% of global GDP. Today, about 100%. So you can see a dramatic increase in corporate debt. And not just in the United States, but in general. The financial markets have given birth to many alternative types of financing, and companies have taken advantage of it. I'll come back to that in a second. Government debt, very similar, went from 58% of global GDP to about 100% today, on average. And I'll show you some data on some average debt to GDP ratios of many countries. Of course, you're very familiar with this in Greece because Greece's debt to GDP was probably over 200% during the financial crisis. And today it's less, but still quite high relative to the average. So these are the four categories. The global debt situation is enormous. Indeed, you can break down the growth rate of global indebtedness by sector, non-financial, household, government, and all of them are growing, but the main growth area is corporate and government debt. To give you an example of how important and serious global debt is to sovereigns, this is data from the United States. Every day, the United States government pays $3.5 billion in interest. And if you multiply by 365, over $1 trillion every year is paid just to service the debt. Not even to refinance it, but to service it. So whenever you have to spend $1 trillion on your leverage financing, you have less money to spend for infrastructure, for social benefits, for Social Security, etc. So this is, and it's growing and will continue to grow. So if the central bank, and you've heard a lot about our president trying to influence the central bank to lower interest rates, it's almost impossible. Even if the central bank would lower the interest rate, you have a tremendous continuing demand for new financing to finance the deficits and the growth of the country. And that will, of course, put pressure on higher interest rates. This data shows for some of the largest countries in the world the growth rate in debt to GDP from 2019 on the left to 2025 on the right. So for example, the United States now is 124% debt to GDP. China, which had very little government debt, is now almost 100%. The largest country, of course, is Japan, but almost all the Japanese government debt is owned by the Japanese, so there's less chance of problems there. France, 114, UK, 104, Italy, 138, quite high. I'm not sure what it is in Greece, but it's about 140, I believe. Is that correct? Something in that range. So it's quite a bit less than it was, but it's still, relatively speaking, quite high. And that means, of course, continuing pressure for the Greek government to finance itself. And perhaps, we discussed this last night a little bit, the need for more financing to increase things like infrastructure and development of the financial and non-financial sector. Here's a fact that you may be surprised about. In the United States, only 20% of the credit extended to companies is coming from banks. 80% is coming from non-banks. That's completely different than almost everywhere else in the world. That's good and bad. On the one hand, we don't need to depend on the banks to finance growth. On the other hand, if the non-bank lending becomes excessive and unregulated, then we have potential problems in excesses. And this might be the situation today. Just in terms of bond ratings, I'm trying to remember, I did some work for a Greek rating agency about 25 years ago. But I don't remember the name, but maybe you can tell me. It's a rating agency here in Greece. What's the name? That's it. And they have subsidiaries now in other countries, I think Bulgaria, Romania, etc. And I did some work for them, not to build models, but mainly to talk about the credit situation. It was a very interesting experience for me back then. But in terms of bond ratings, credit ratings, the United States, of course, has the largest corporate bond market in terms of dollar amount outstanding. India has a huge one as well. Most of the companies are investment grade in dollar amount, but we have an active non-investment grade market or junk bond market of about $1.5 trillion today, and I'll spend more time on it, the BB, B, and CCC categories. So let's talk about leverage finance. 3 types. High yield bonds, leverage loans, or another name is called bank syndicated loans, and direct lending, non-bank lending, shadow bank lending, private debt. They all are synonyms for this new category of non-bank lending. And in terms of the current numbers, we estimate somewhere between $5 and $6 trillion of leverage finance in the United States. They exist in other countries. Europe has about 500 billion in high yield bonds, mainly in Scandinavia, Germany, UK. But these are large companies issuing bonds that are not investment grade. Leverage loan market, BSL market, about 1.6 trillion. And the biggest growth area by far now is private credit or direct lending. Somewhere between 2 and 3 trillion, depending on who is doing the counting. Here again is the nomenclature of bond rating agencies. Many of my ex-students work for firms like Moody's, Standard & Poor's, Fitch, and most other countries have local rating agencies that have grown in importance as the bond and loan market increases. Again, you have the two main categories. We're going to spend most of the time on the non-investment grade. So let's talk about this enormous growth of private credit, because this is the epicenter now of a lot of concern. Very little concern, you may be surprised, about default rates, recovery rates, liquidity of bonds. But loans, and particularly non-bank loans, is the biggest growth area. You might be interested, about 87% of U.S. companies that are more than 100 million in liabilities are privately held. And most are owned by private equity firms. So the symbiotic relationship between private equity and private credit is critical for the understanding of the growth of this market and its current problems. So 87% privately owned companies, and privately owned companies, mainly owned by private equity firms, primarily look for credit from private credit firms. They can borrow money from the public markets, but they generally don't because of this continuing liquidity issue that they've enjoyed for 15 years now. So this shows you the growth rate of private credit in the US. So in 2018, it was about 1.1 trillion, and today we estimate about 2.8 trillion. Some people say it's 2 trillion, some people say it's 2.5 trillion, depending on if they consider what's considered dry powder. That's money raised but not invested yet. Anyway, tremendous growth rate. And I'm going to talk about the various types of firms that issue private credit. This shows you the enormous growth rate from 2017 to the present in all leverage finance, and the blue line being the biggest growth being private credit. So this chart, it's a little complicated, but it shows you the way private credit firms primarily are structured. So you have what's called a master fund, and that's the private credit fund. And it gets its financing from several sources. First, there are about 60 private credit firms that issue equity in the stock market. So individuals like you and I can buy equity in a private credit firm through what's called a BDC, Business Development Corporation. And there are, as I said, about 60 of them. Or you can buy an ETF, so you can enjoy or suffer from the general movement of private credit firms by buying a portfolio of private credit firms. I do some work for one company called Golub Capital. It's about $80 billion in assets, and it has a publicly owned company, but it's only about 10% of its funding coming from the stock market. In addition, we have at the top what's called feeder funds. A feeder fund is a fund that gathers money for the private credit industry, and it gathers it from either wealthy individuals, but primarily from other financial institutions like insurance companies, pension funds, endowments, and even from governments and banks. And they feed the money into the master fund. Some of those special purpose vehicles are leveraged, so it's not only equity money coming in, but it's debt coming into the master fund. In addition, and this is the one that bothers or is concerning now for the European Central Bank, for the Federal Reserve, for central banks in some other countries, and that is bank lending to the master fund. And bank lending can come in the form of direct loans or lines of credit. And the question is, why are banks financing competitive financing companies? And it's very interesting what has happened. Why do we have this big growth in private credit? And the main reason is the great financial crisis spurned regulation that banks have to limit their lending to risky companies. I'm sure it's happening in other countries as well, but certainly it's happening in the US and in Europe. And as a result, with the growth of private equity and the need for financing, the money had to come from somewhere else. And it came from private credit, non-bank or shadow bank lending, primarily to fill the void that the banks had done before. Now, it's much less in European countries, we know that, but it's growing. And it's growing with either domestic private credit firms or a lot of American companies are coming over, like Apollo, Ares, KKR, and the like, and opening up subsidiaries in Europe to make loans, because the European banks also have cut back on lending, particularly to small and medium-sized firms. And we'll get to that in a moment. Anyway, the point that is very much of concern now is how much exposure the banks have to private credit. Now, this was not a problem when private credit was doing very well. And what do I mean by very well? Well, first of all, growing. Second, the average dividend paid by private credit firms to investors is around 8 to 10%. Now that's a very high dividend for leverage finance. And of course, if you add leverage to the system, the private credit firms will have to earn a lot more than 8 to 10%. So the average dividend yield on a private credit firm listed on the stock exchange was between 8 and 10%. The average yield on most US corporates is 1 to 2%. So you can imagine how attractive private credit firms were, and still continue to be somewhat, but not in the last year. Because not only do investors expect and have received 8 to 10% yields, but also the stock price was rising for these companies. So it seemed to be a win-win situation, but that has all reversed in the last year, mainly due to several phenomena. One, and you've probably read about this, there's too much concentration, it's thought, among lending to software companies who have had enormous leverage needs and fulfilled it through private credit. 20 to 25% of all lending was done into software companies. Second, there were a couple of high-profile bankruptcies of companies that used fraudulent types of financing that were not detected by the private credit lenders, particularly using the same assets as collateral to multiple lenders from multiple financings from different private credit firms. And this got a lot of publicity. And third, the stock market started going down in the private credit firms. And this led to investors asking for their money back, redemptions. The problem for investors, for the most part, not if you own common stock, because you could sell that stock and get your liquidity. But most private credit lending is private rather than publicly owned. And so, this is a lot of detail, but you may want to look at it when you have more time. We have three types of these BDCs: publicly traded, perpetual life, and private placement. 90% are these second categories. And the liquidity is quite different. So while it's daily liquidity for publicly owned BDCs, perpetual life and even worse private placements have a quarterly liquidity. So if you want your money back, you must put in a request and they have 90 days to pay you. And second, there's a cap of 5%. Now, when these concerns of software companies, of big bankruptcies with some exposure for private credit, and also banks' concern, you may have heard the famous quote from Jamie Dimon, the chairman of JP Morgan, about finding cockroaches. Do you remember that one? Well, some of you may have read it. And whenever you find one cockroach, there's probably many others. And he's talking about some of these high-profile bankruptcies that came to fore. And a lot of these lenders have need to report on their performance, but they don't need to report to the general public except if they're publicly held. So I'll get to that in a moment. But in general, liquidity is not very good beyond this 5% quarterly maximum amount. And this is causing a lot of redemption requests greater than 5%. Some companies are meeting that, like Apollo. They are meeting, but their requests are 14, 20, 25% of the assets under management. So what happens when you have a fund and you have lots of requests for redemptions? Well, if you want to meet those requests, you either have to sell some of your assets. And what are the assets? These are privately held companies who borrow money, mainly owned by private equity firms. And it's a difficult period right now for private equity to sell their assets. Or the private credit firms has to issue more debt to pay the redemptions. Or they have to reduce lending. And so all of this is happening to some extent. The big question are two. One, how much exposure do the banks have? And how much exposure do insurance companies have? So I'm not sure, I haven't studied the insurance industry, but I think it's definitely an issue. This shows you the trend in private credit as a share of life and annuity insurers' investments from 2014 to 2025. So we're talking about 25% of their assets are either directly or indirectly exposed to non-investment grade companies. And this is where, of course, if you have a credit cycle that goes bad, you're going to have much higher defaults, because this is where it all starts from. And we can look at how the private credit funds are funded. also bank borrowing. So I'm not the only one, but a lot of people are asking this question, including central banks, ECB, Fed. How much exposure do banks have? And the estimate is around $600 to $700 billion exposure to lending to private credit firms. In my opinion, that's not so much. I mean, it sounds like a lot of money, but it's really not so much. When you think about it, let's suppose we have a financial crisis, a 10% default rate for 2 years of non-investment grade companies. So 10% of 600 billion is 300 billion, and the average recovery rate of a bank on a loan to a non-investment grade company is in the vicinity of 50 to 60%. Many times these are senior secured loans or senior unsecured loans, and the recovery rates are generally reasonably high. So let's say it's 50%. So 600 billion exposure, 300 billion of 10% default rates for 2 years, that's 120 billion, so a loss of around 60 billion to 100 billion. It's not going to break the bank, so to speak. So I don't think there's a systematic risk with respect to banks. I'm more concerned with insurance companies because their exposure is much greater and they have their own regulation that may try to limit the lending in the future to private credit firms. So we have to watch the redemption requests from financial institutions. We know that there are going to be a lot from retail customers. It might be of interest to you to see that many private equity firms also own private credit firms. So this is the dollar amount of assets under management of private equity firms like Apollo and their private credit industry. Blackstone, Ares, Brookfield, KKR, these are the big ones. And they have a lot at stake for the private credit industry to continue to survive. And when they have that, you're going to find that they're going to do whatever they can to try to calm the market with respect to the current situation. My concern with private credit is how they report defaults. So I'd like to take you through a little analytics with how you calculate default rates. I'll get to this in a moment. Okay, so these are 3 statistics that I've seen with respect to the default rate of private credit in the last 12 months. 1.2%, very low. 5%, above average but not dramatic. And almost 10%. Nobody is reporting 10% default rates in terms of the private credit firms. However, there are a few of us who calculate what I call a shadow default rate for private credit firms. And let me explain how that works. There's another feature of private credit that you may have read about. It's called PIK loans, payment in kind. Let me explain. Some private credit firms, when they make loans to private equity-owned companies, put in an option on the part of the borrower to pay in kind. And what does that mean? It means that normally they pay interest in cash, but they have an option, and the technical term is toggle, T-O-G-G-L-E, to switch from cash pay to pay in kind. And what is pay in kind? It's to pay the interest in more debt rather than cash. So for example, a company borrows $100 million, has a 10% coupon or interest rate, needs to pay 10% or $10 million a year in interest. But it has a cash flow problem. And it switches, because it has the option, to PIK. That means they have to pay, or do pay, 10% of the outstanding amount of debt in additional debt to the lender. Well, but that's considered income still for the private credit firm. And as a result, they should be paying dividends on that $10 million, but that they never received $10 million in cash. And so this PIK option, how prevalent is it? So our analysis showed it's not a huge amount, but it is about 13.5% of all private credit loans have the option, but 54% have exercised the option. So all you have to do is multiply the 13.5%, which is the percentage of firms that have the option, by those that have exercised the option, and you get a default rate, shadow default rate of 7.3%. If you add that to bankruptcies, well, there is another chart here. There are three types of defaults in our market. Bankruptcies, everything is in default. Missed interest, but not cured in the grace period, usually 30 days for bonds and 90 days for loans. That's also considered a default, like an NPL. And now we have a new phenomena called distressed debt exchanges. Tell me if they exist in Greece, or in Italy, or in Europe in general. A distressed debt exchange is where the company has some debt coming due. It hires its lawyers, or actually the clever lawyers go to the firm and say, you seem to be having a problem paying your interest. Why don't we do an exchange? And we propose to the creditors a change of the contract that we originally agreed upon. For example, instead of paying interest of a certain percent, we're going to change the percent. Or instead of the debt coming due this year, we're going to extend the maturity by 3 years. Or we're going to offer you cash at a discount to par value. And these type of exchanges have become incredibly popular in the last 5 years. So we have a new paper out studying what's called DDEs, distressed debt exchanges. And not only, it's kind of really troubling, but it's taken effect. Not only do we have a huge increase in these exchanges, but we have something called creditor violence. And it sounds very dramatic, and it is dramatic. It's where a group of creditors, the majority, form a co-op and propose some changes in the debt structure by, for example, issuing more debt or putting some more equity in the company, and eliminates the minority from participating. I don't want to get into this very much, but the technical term is LME, liability management exercises. And this has become quite common in distressed debt activity, and it is changing the landscape. It's also making the new contracts of debt See, we have this situation, maybe you have it here in Europe too, called covenant light. Covenant light means less protection for creditors when they make loans to companies. And that was mainly due to a big increase in competition, in liquidity. And private credit is the main reason why they've had this increase in competition. Anyway, let me just get back to this concept. So my guess is that the real default rate is closer to 10% in the last year or two. Why? And this will be the next to last thing I speak about today. The last thing will be to return to the credit cycle question. And this is the issue of, I'm going to wait on this when I introduce Gabriele. Talk about a market in Italy called the mini bond market, which some of you may be familiar with. We'll get that in a moment. So the bottom line is, if we have 10% default rates and it continues, and there's going to be a great deal of call for more transparency about the default rate of private credit. This will lead to more regulation and probably a reduction in growth rate in private credit. The problem with a big drop in private credit will be also, I believe, a drop in private equity. The two will go together. However, I'm not predicting that private equity will simply end the way we know it now. It probably will continue to grow, but not as fast as it would have if private credit was continuing. I do have, let me just mention one thing, and we don't have time to go through it now. To figure out where we are in the credit cycle, we have to be able to have metrics to measure certain key variables: default rates, recovery rates, new issue liquidity, and what we call distress ratio. And let me explain now where I think we are and where we might be going with respect to the 4 spectrum credit cycle. Historically, this is a lot of data on distressed debt exchanges and bankruptcies. Okay, this is the last graph I'm going to show you. Okay, this chart shows 2 main variables. The yellow bars represent recessions in the United States, and the solid line represents default rates of high-yield bonds from 0 to 12, 14%. And if you concentrate on the last 4 recessions, 1991, 01, 02, 08, 09, and a very small one during beginning of COVID, if you look at the default rate on high-yield bonds, we notice that, for example, the default rate, this horizontal line, is the average, around 3% a year. So notice that the average went from under 3% to above 3%, and then peaked during the recession. Again, below the historic average, above the historic average, even further, and then peaked during the recession of 01, 02. And then the 08, 09, look how low it was in 2007. In 2007, anything got financed because creditors became complacent because defaults were so low. But they escalated in late 07, beginning of 08, and then peaked in 09. And then it started during 2 years before COVID, but stopped at around 6%, and then came down. The Fed pumped enormous amount of money into the system. Central banks began buying corporate bonds for the first time and putting it into their portfolio to increase liquidity, and it worked. Although it led to inflation, as we're all experiencing. So here's the issue today. If you look at default rates on bonds, they're very low. Last year, the default rate on high-yield bonds in 2025 was under 2%. Non-investment grade companies. But if you look at the default rate on loans from banks, they were much above the historic average. Why were bank loans suffering such high defaults when bonds to the same type of companies was having a low default rate? Usually, the two have a correlation of about 0.9. But last year, in fact, it started in 2024, they became very separated, dichotomous, with much higher default rates on bank loans, and I believe also on private credit, although it wasn't being reported. And it's a very simple reason. Bonds are fixed rate. They don't change with inflation. Loans are floating rate. They change with interest rates, with inflation, with central bank activity, etc. And we've had increases in interest rates, as you all know. Maybe more so in the US than in Europe, but certainly everyone is concerned with inflation and higher interest rates. So here's my dilemma. Do I look at bonds or loans to determine where we are in the credit cycle? And do I look at private credit or do I look at bonds to determine some of these metrics? And since private credit is so much more important now than bonds and is growing, I'm looking much more at that. But the reported default rates are all over the place. So if you look at Fitch, if you look at UBS, some studies, they're beginning to say, oh, I think there is somewhere between 5 and 10%, not 1 and 2%, which is being reported to the SEC through publicly traded BDCs. So my conclusion is we are in somewhere between average and stressed in the credit cycle. And if you believe this chart, how do you vote? Does the credit cycle lead the business cycle or vice versa, or are they coincident? So I'll leave that for discussion with the coffee break or the food in a little bit, but I'm telling you, my conclusion is that the credit cycle leads the business cycle. But if you ask most macroeconomists, I think they would argue the opposite, that the business cycle, because it's very clear, if you have a recession, you're going to have a lot of defaults. The question is, which comes first? And what does that mean for the U.S. economy if we're looking at, for example, default rates rising on the bank loan and private debt market? It probably means that we could have problems. And I think one of the reasons why we have such a great high default GDP growth rate is AI and data centers and the like, which is driving tremendous amount of investment and borrowing from private credit. Okay, last thing I want to mention is my introduction of our next speaker and also a little bit about Italian mini bonds. So in 2016, I got a call from the Borsa Italiana, the stock exchange in Milan. And they were interested in my working with them to build a early warning system for credit problems in the new market called mini bonds. And a mini bond is just what it sounds like. It's a bond issued generally by a small and medium-sized company that's small in size. The average mini bond today, and there are about 150 mini bonds issued last year, is about 10 billion euros. The average junk bond in the United States is several $100 million. So one is much larger than the other. And of course, it was the government's stimulus tried to stimulate alternative financing for small and medium-sized companies in addition to banks. So they asked me, could I build them a kind of a Z-score model, but for SMEs, or they call them PMIs, small and medium-sized companies. So I said, no, I don't think I can do that because I'm based in New York. And they said, oh, well, maybe you can find an Italian to work on. And I found one. His name is Gabriele Sabato, and he was a visiting scholar at NYU in 2003. And we began looking at small companies financing, mainly around the time of Basel II being introduced. And Basel II distinguished between large companies and small companies, I think 50 million euros being the criteria. And so I asked Gabriele, would he be interested to work on a kind of early warning credit scoring model specialized for small and medium-sized Italian companies. And he agreed, and we worked on it, and he did most of the hard work. And we produced a model which then the Borsa made available to their investors to try to promote secondary trading in these bonds, because there was almost no secondary trading. And still today, there's not a lot. But they wanted to increase the transparency of the risk. And Gabriele and I built the model. It worked quite well. And we started a firm called Wiserfunding, based in London. And that firm continues to exist. And I think Gabriele is going to talk to you now a little bit about how credit scoring models that we've built, and maybe others, have evolved recently, particularly by adding new technology into the credit rating decision. So I'd like to now thank you very much for your patience and introduce Gabriele.
I always have this problem to come after Ed, so it's very hard to present after Ed, but thanks for the introduction. So my name is Gabriele Sabato. I'm the co-founder and CEO of Wiserfunding, and it's a company that Professor Altman and I started almost 10 years ago. So it was the idea to basically look closer to the SME world and how we could find the data to support the financial industry in lending, investing, insuring SMEs. Because that was a big issue. And still today, when I speak to banks, insurances, it's a big issue where to find the data. And the more the economy becomes digital, the more data needs to be available, readily available for these banks, insurances, asset managers to offer their products to SMEs. So this was basically how we started 10 years ago. And we realized right away that models were fundamental. I mean, obviously our expertise, as Ed mentioned, we had done already some work in that space, but technology was at least as important, right? To retrieve data in real time, we needed to use the latest type of technology. And already at that time, AI was available. I mean, AI has been around for many years, not just the last two. Machine learning, deep learning, I'll mention that, and after me, we'll see other uses of AI to the consumer's world. So that was a key element for us, to use technology, AI, to retrieve data for any company across the world in real time, process that data, and then feed variables into our models so that our client can basically receive all the information they needed to take a decision, to basically understand better who they were talking to. So that's a bit the history of how we started. And obviously, in the last 10 years, we grew quite a lot. We have more than 60 clients globally. And one of the numbers I'm most proud of is obviously 3 billion that our clients have been able to lend to SMEs thanks to also to our data, to our risk metrics. So really, everything starts with the digitalization. And when we started, I mean, that was a bit like, it took us about 2 years to get to the point where we could really offer our solution, and then COVID hit. So we thought, wow, what's going to happen now with COVID? No one really knew. But in reality, the pandemic was a great push toward digitalization, right? A lot of the processes that were still running in, let's say, in a less digital way became more digital. And, you know, many bankers here, you probably know relationship banking. Obviously, relationship banking is key when we're talking about corporate lending. But for small companies, relationship banking is too expensive. So really, the process needs to become digital, and banks need to have the ability to understand this company better in few seconds using digital data. So that is really what we provide, that help in the digital world. And data, I mean, we all know that's an issue with data. For consumers, for companies, there is a lot of raw data. Many now say that data is the new oil, and it's probably true. I mean, data is behind everything. Ed mentioned he was very happy to have a lot of bankruptcies. Otherwise, we cannot develop models. And in reality, today, data is out there, right? It's just the question is how to access that data in real time and process that data in real time. And that's the key. So yes, accessing data inefficient, but data is there. And, you know, this data is very often inconsistent, so coming from different sources in different structure. And I guess I was meeting someone from technology before here from Snappi Bank. Obviously, that's a big headache, right? When you have different sources, different API, unstructured data, how do you build that structure? How do you reconcile this data so that you're gonna have a portfolio view? So, and obviously, very often, data needs to be cleaned. And so all this, on the top of all this, you need to be able to do this in real time. And I'm sure we'll hear more from your colleagues after and their experience with consumer data. But this is a problem. The real issue is data is there, but there's a lot of things that needs to be improved. And that's where we thought there was space for us to basically go to the source of the data, the raw data, and get that data clean and process that data to be able to then provide a structured input to our clients. So that's the process. How we do that? Well, can AI help? And, you know, I'm gonna cover this very quickly, just because I know we're gonna talk more about AI later, and I'm sure you're all kind of tired to hear about AI. It's everywhere, but it is the future, right? I'm sure many of you are using AI for different things, and yes, AI can help, right? It depends how you want to use it. I mean, there are multiple ways to use AI, but what is AI? I mean, basically we all know what AI is teaching a machine to behave or think like humans, right? How you do that? Well, with data, again. We go back to the thing. You need a lot of data to train models called LLM models. These models get trained, and they trained and use machine learning and deep learning to basically think the way we would think, right? So today, we can teach these models to do things that maybe our analysts would do in the past. Go to a website and tell me really what is the activity of this company. Yeah, before we would need to do that, right? And today you can teach a machine to come back and tell me what they think is really the activity of that company. Or if a company is certified, go and find a specific logo on the website. So there are many things that LLM models can do for us. And obviously, we're all familiar with this, but as I mentioned, today, ChatGPT, Claude, all these, they use deep learning, which is the most advanced type of AI. But machine learning has been around for many years, right? So AI has been used in credit for many things. I mean, we probably go back 50 years into papers using machine learning to develop models. But AI today can be used in many other ways, right? So we're probably familiar with some of these, robo-advisory, maybe many of us can have, I don't know, different type of translation, real-time translation, and many type of AI uses that are absolutely key in today's world. In credit, well, again, model development is definitely the oldest way to use AI. One thing we do at Wiserfunding we found very helpful is using AI to retrieve data. Again, especially when you're talking about SMEs, and we'll hear more about consumers, I'm curious there, but for SMEs, you all know the financial history is not going to give you the full picture, right? Small companies, they disclose something, which is a picture, which is a limited picture. So you need to be able to retrieve other type of data that can give you a better picture. And the only way to do that is to use some sort of AI, because most of that data is unstructured. So when you want to understand, you know, really what type of company is that, a family business, have they been on news recently, what type of structure their board has and all that. I mean, yes, an analyst would retrieve that information and use the brain to, you know, understand if it's a good or a bad thing. Wonderful. But can we teach AI to do it? Yes. And that's exactly the way we use AI in Wiserfunding. So another great use of AI is also to summarize things. So again, if you have a risk assessment report, I don't know if many of you here, I guess in the bank, in corporate banking, you still prepare credit memos. Now, credit memos, we work with banks that used to put together 40 pages credit memo. Again, AI can do all that, can simplify, and let me tell you, sometimes can do a better job than humans, because it's the way it's structured, would give the same structure to that report. Okay, so also for us, when we extract data and provide reports, again, AI helps us to summarize that report in a way that is more understandable by individuals. And then the last, I mean, you probably all hearing about agents. I mean, I heard all this like, oh, we've got 200 agents working for us and so on. So agent is basically using AI to do work for you. And again, something that we have recently introduced also in our solution is the ability to basically interact with the platform. So use it as a colleague, like you can ask, you can talk to, it's quite funny, but you can actually talk to the platform and ask what do you think about this company, get an answer, ask to go deeper, the same way you would interact with ChatGPT or Claude. So you're basically getting, an analyst for you that does all the research and gives you a response with what they think also in terms of probability of default, loss given default, and all these credit metrics. So amazing things happening there, and technology is really what is fueling all these changes. The solution we built, also very important, goes all around the credit cycle, right? And this is key because today all banks need to have solutions that can support from origination to portfolio monitoring and the regulatory piece, so IFRS 9 and capital. So all this is something that can be supported. And that's like, just to finish, give you an idea of what type of data we use. As you see, there are 3 core modules in each one of our models, looking at financial information, obviously, bit of the legacy of the original Z-score, and then the other 2 modules, one looking at non-financial information, so everything we can find non-financial about the company, corporate governance, ownership structure, news, legal events, and then the macroeconomic information about the country and the sector in which the company operates. These are the 3 core modules, and then obviously again we can ingest any type of data from private or public sources, so bank data, transactional data, and so on. So it's an avalanche of data that obviously potentially anyone can access, but to access all these sources and reconcile and structure them in the same way, that's the difficult part. I'll close really here, and I think this is probably a good way to introduce the next speaker. So AI and solution like the one we have developed at Wiserfunding can support multiple processes in a bank. Now, obviously, that's all about automation. Automation for SMEs is key. As I mentioned before, the margins are not the same as large corporate, so the only way to make that segment really profitable and interesting for a bank is to increase automation in all these different steps of the workflow. And this is probably even more important for consumers. So now we're going to hear from George and Yannis about their experience in working with data for consumers and how they've used AI and the typical, let's say, corporate type of methods to develop models and apply this to the consumer world. Thank you very much. Yeah.
I'd like to, yeah, first.
Thank you.
One thing, the way I look at AI and traditional models and how I like other people to think about it. Me? It's okay. Can we use this? So a question that always comes up, particularly in the academic literature, is new researchers always, and it's normal, present their models, and usually they present it as a substitute or an improvement over an existing model. That's the way science generally evolves. With respect to AI and our experience at Wiserfunding, and something that I feel passionate about, is that a better way to look at whether it's AI or traditional, let's just say, credit scoring models, which is better, and is, can the two complement each other? Can they work together rather than one to substitute for another? So at Wiserfunding, what we've done, and I don't see this that often in the literature, is identify and measure the value added of adding AI to what a traditional model had before contributed. So for example, on accuracy models on predicting defaults of companies or individuals, our results based on the Borsa Italiana model was in the vicinity of 75 to 80% accurate. When we added the non-structured AI-related variables starting in 2018, 2020, we found that the accuracy level increased by 10 to 15 percentage points. Now that might not seem like a lot, but when you're talking about going from 80 to 90, 92% accuracy, it's a great value added, but it's the combination of the two rather than one or the other that at least I believe is the better way to go. And it's much more explainable to practitioners than simply a black box AI type model. So I'd just like to throw that out to you. So now you can introduce our next speaker, I guess.
Well, thank you very much. My name is George Tsomidis, and I'm a senior advisor here at the Snappi Fintech and AI Lab. Today you will see two projects we have been working on in the lab. So the title is A Small Journey from the Z-score to the probability of default, where the Z-score has been used over half a century to predict companies that are going to default. And we are specifically interested in individuals that have been so far left outside the financial market regarding credit, especially the ones that are thin-filed or, in other words, are unbanked. So I will present a theoretical framework with the name Credit Adjusted Financial Resilience Index, which is going to be based on transaction data rather than credit history. It's really an honor to present our work in front of Professor Altman. So the whole idea that makes this talk possible for about 60 years, the Z-score had done something that has been really important regarding the later risk of companies failing that can be written in advance in a handful of financial ratios combined in a statistical rule rather than judgment. So default has become a measurement, not just a matter of opinion. So some credit bureaus took this idea, moved it from the firm level to the individual level. However, the data remained monthly, sparse, and has been backward-looking. So with the advent of PSD2, transaction flows will give all the necessary data and all these behavioral insights that would make the models more efficient and with more rich outcomes. So the question that organizes this whole, let's say, talk is whether if a firm's solvency is a statistical object, can one have the household's resilience, of course, always regarding credit, regarded as one, too. So the problem we are underwriting into, traditional underwriting fails where the need is the highest, regarding applicants with no credit history that are not necessarily low-quality borrowers, there are just unobserved ones. So in Greece, there is also a structural backdrop that sharpens this situation even further. So it's two sides of the same coin. Household expenses are accounted for about 70% of the average salary, and this affects almost 30% of the population. And on the other hand, we have the private sector that pays 14 salaries instead of 12. So a paradox is being created, where this very volatility that has been that is introduced from these 14 salaries excludes applicants, where the bureau score itself may be reached a high-frequency signal if one reads cash flow and not credit history. So exclusion is an instrument problem and an error in measurement and not a verdict regarding the risk itself. What follows would actually interrogate two questions. The first is whether corporate default logic can be transferred to the individual, so we want to see which principles survive and which new signals may emerge from this data that are going to be real-time, and also behavioral insights are going to emerge. And the second is access, whether AI and data in general can unlock the credit for these that have been long excluded. So credit worthiness can be read from PSD2 flows before any bureau file exists. However, this means that the AI system we are employing does not merely price risk faster, it also extends the observability frontier, but the question that rises is whether we can do so without introducing any new biases in the scoring itself. So to put the two worlds side by side, we start from 5 audit balance sheet ratios and we move to PSD2 cash flows. The combination rule from a linear discriminant analysis producing a Z-score to a logistic generalized linear model where calibrated probabilities of default can actually flex the shape of the function. The risk concept shifts. We have the distance to insolvency of the entity to distance to liquidity of the cash flow. And of course, we are moving from static snapshot to trajectories, especially focused on savings margin and debt stock. So the principle that survives is that default itself, it's a combinable low-dimensional latent signal, and what changes, it's the observability. The pipeline for a CFRI, it's 4 stages. First of all, we inject transaction data in the system. We also geo-index essential costs. We engineer 3 stressed components: buffer, momentum, and stability, where we treat each individual as if he or she has taken already the loan. We feed the logistic GLM and let some flexibility in the buffer component, and also we apply the affordability hard stop. We calibrate the probabilities of default back to the true range and also validate out of time, or in other words, we backtest the model. The first move, however, is to neutralize the cost of living before risk is ever calculated. So we retrieve from the National Statistical Authority essential expenditure baseline, which has been scaled by a regional coefficient. And this matters because usually in most models, regional expenses, where is arbitrage within the country regarding household costs are not taken into account. And we apply them directly into the affordability measure, and the only component that it is used in the model as regional, let's say, information is regional unemployment itself. We have 3 behavioral dimensions: buffer, which is how many months of post-loan obligations the individual can afford given liquid of assets; stability, which is decomposed into income predictability, how steady cash inflows are, and payment reliability, whether there is clearance on bills given essential expenses; and on momentum, again, split it into 2 parts. One is the savings margin trajectory. We are interested to see whether it's uptrending, and the second is the debt, to see whether the debt is getting paid down. To calculate income stability, we use the coefficient of variation, with the standard deviation of income over its mean. A naive approach would be to cap it at 1. However, you can see the red line where it dies near 1. But the problem there would be a significant part of the population that is documented, let's say, to have a coefficient of variation above 1. And this is exactly that part we want to serve: the gig, the seasonal, and the multi-earners. So instead, we use this functional form, 100 over 1 plus the coefficient of variation, which is monotone, bounded, and the most important, it's alive in the tails of the distribution, so it does not floor to zero anyone who has a coefficient of variation above 1. This is the classifier itself. When we see the log odds are simply the sum of interpretable terms, we allow some flexibility for the buffer component where we apply a restricted cubic spline. This is a way to linearize the component because there is a strong reason to be non-linear. Risk steeps abruptly to say when coverage rises, and actually creates two groups: people that are good candidates for lending or not. Above this model, there is a hard guardrail, a hard stop, which is the affordability veto, where we compute net financial flows, which is income, essential expenditures, geo index, discretionary spending, debt that has already been realized, and the new installment. If this has a positive value, then we score the individual. If it is negative or zero, then no matter the score, the individual is rejected. And why is that? Because the regulator, Bank of Greece, permits debt service to income up to 70%, but low-income households, because most models do not take into account regional household expenses, are keen to default. So the veto enforces a cash flow for. Prudence is a hard constraint and also creates the sample the model is trained on. We have to be honest what this model can and cannot claim. First of all, we have sample selections, what we observe. And if we go one layer deeper, the model learns, but these applicants that have already been approved. So we do not say that we theoretically tackle this problem, we just mitigate it for now. We also have class imbalance, so default is rare. We need to correct the sample that the model is trained on, usually using the King's-Egg correction methodology, and also have discrimination calibration, how accurate the probabilities are and how well the model ranks risk. So one could argue that it's really a transparent GLM and old-fashioned, let's say, statistical core. So the AI itself, it's not living inside the vertex of the model, but upstream and around the core. So what it does, it's extracting the signal from the data. It is orchestrating agents in order to compute trajectories, coefficient of variation, apply the veto. It also does continuous monitoring regarding whether the model drifts or not, and eventually it runs the reject inference engine, which is exactly the problem where you have a model that's been trained on data of persons that have already been approved for lending. So to wrap it up, whether AI and data widens the access, the AI can actually extend the observability frontier, and the appliance of this affordability veto guarantees that inclusion does not tip into predatory lending. However, three conditions have to be met. The first is that the cash flow features can encode protected attributes, so excessive testing must be done. Until reject inference is solved, as access is measured only by the approved individuals, and every agentic layer, one used in an AI model, trades interpretability for risk. Thank you very much.
Great. So, hello everyone. I'm Yannis Nikolaidis, and I'm a senior data engineer at Snappi. So, I am going to talk about something we have been working on lately. So, as you can understand from the presentation, there is a problem. There are some the traditional credit models rely heavily on credit history. So, There is also the fact that a significant portion of the population does not have a sufficient history. We do not have data to assess their creditworthiness. So what can we do in these cases? Like, how can we assign a score to those people? Essentially, we do not. We consider them as unbankable. So that leads to financial exclusion, and we have thought of finding a solution to that very problem. So we have been researching and experimenting with several aspects, and we asked ourselves whether alternative data can be a solution to that, and instead of financial and socio-demographic ones, which of course in the cases of the thin file are significantly absent. So we came up with an idea. We asked ourselves, can we predict if someone is going to default from just a conversation with a chatbot? And we've built an application that is basically part of a microloan. It's a screening assessment, part of a microloan application, to evaluate the characteristics of the applicant. So, how are we going to quantify that? I mean, what are we actually looking for in the text? So, we're looking for behavioral characteristics that the behavioral literature links to repayment. And those are locus of control, time discounting, and resilience. So, locus of control. Locus of control basically reflects the extent to which individuals ascribe the control of certain events that happen to their lives to themselves versus to external factors. Time discounting is basically synonymous to patience. So would you, let's say, prefer to delay gratification over the potential benefit of a higher yield in the future? And finally, we have resilience, which is all about the capacity of an individual to absorb, adapt, and recover from hardships. So as you can see in the slides, we have 3 questions asked in the assessment. So each one mapped to the individual dimensions. So to evaluate the locus of control, we ask the last time something unexpected broke down, what was your very first action? So for example, we basically want to see if you tried to fix it, or did you just delegate the task to someone that appears to be more capable about it? The second question is, if a friend gets 2,000 euros tomorrow, what do you think they're going to actually do with it? And although we're asking something about your friend, we expect that you are going to project and talk about yourself. And the last one is about resilience. So we ask, if the loan wasn't approved, what would be your first thought and the next step? And we're basically putting you into a scenario that you wanted to get a loan, you didn't get it, and you are facing a hardship. So are you going to bounce back? Are you going to bounce back from that or not? And we expect that this probably says a lot. So the concept of the application is pretty simple. So we are giving you, it's 5 minutes. We're giving you 4 questions. The 3 of them are the behavioral ones, and the one, which is always the first one, aims to capture the intent. What is the loan purpose? So the assessment begins. We're asking to state your loan purpose. How are you going to use the funds? And we categorize the result between consumption, emergency, and business. And of course, this classification carries a weight in the final score. Then the behavioral questions come that we have discussed in the previous slide. And finally comes the scoring. So the concept is simple. So we basically ask the large language model to give a structured score from the text. We do not ask it to give the final result, just give a score. Then we take the score, we input it into a deterministic mathematical model, and then we derive the final probability. So I think this is the most exciting part, because you are going to be the first ones that you can try it and tell us what you think. So in order to connect to the application, you have to be connected also to the guest Wi-Fi network. So apologies to the people who are watching us from YouTube. But yeah, before we dive deeper into the scoring mechanism. So I'm going to give you like some seconds. So I think we can move on now. No worries, we're going also to share again the QR code in the end of the presentation, so we'll have plenty of time to experiment with it. So, to give an understanding of how the scoring mechanism, we have to forget about probabilities and percentages for a moment, because we have translated it into an angular state. So just imagine that your probability of default is somewhere inside the top right quarter of a clock. That ranges from 12 o'clock up to 3 o'clock. So 12 o'clock means that it is absolute certain repayment, and 3 o'clock means that this is certain default. So whatever you say counts. Every word counts, the way you elaborate it, the way you articulate it. So under the assumption that we know nothing about you, we do not have any financial data to evaluate your credit worthiness, we say that, okay, your probability at the beginning is just a coin flip, it's 50%, so in the angular state, you are right in the middle, right in the 45 degrees. And then, as you talk, and as you state, let's say, your loan purposes, say it's a productive purpose about a business, or it is, or in the behavioral questions, you appear to be very, very resilient, or maybe you are not that resilient, and you are not, let's say, responding well to hardships. The needle goes towards a certain direction, giving you the final score. And in our final slide, yes, we have to also take into account that you are going to cheat on this tool, and for the purposes of this presentation, we have identified an authenticity score, which is basically equated to your to the readability of the response, and also how much of the text that you have inputted in the responses is copy-pasted. So, well, to put it simply, if you copy-paste your whole answer, and at the same time your readability score is over the roof, which means that you are writing as a PhD thesis, there must be something wrong. It's probably not a spontaneous answer, so you are completely penalized, all the weights are nullified, and you return back to baseline. So that was all from me. Yeah. Sure, yeah. Mm-hmm. 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 Is not? Is it? Mm-hmm. Mm. Okay. Yeah. Yeah.
So, thank you all. Live transfer is over. Thank you. Let's make a big applause for everyone, because it was also hard to follow sometimes. And I usually we do Q&A like here from the States, but I suppose you are quite tired, so we have some wine and some little snacks. So perhaps let's make Q&A differently, like there, like together. So let's go and grab some good Greek wine. Asyrtiko from Crete.